I'm Jim Schultz. Welcome to the afternoon edition of Options Uncapped, the back half of the double feature. Man, I'm glad you guys are here because we are going to have a good time over the course of the next 10, 20, maybe 44 minutes today for the afternoon session. We are getting back to the basics, guys. So today's afternoon session of Options Uncapped is sponsored by Sour Green Apple Ghost. I mean, they don't know that they're sponsoring it, but they are most certainly sponsoring this show because we are getting absolutely rinsed on this MGC EQT from this morning that you guys saw live on the show. I thought, man, we got to bring a little Ghost onto the program. I've already been drinking it. It is phenomenal. You know it's phenomenal. I know it's phenomenal. Welcome to the show. Okay, so if you are watching this show anywhere other than right here, then you're doing it wrong, man. You got to be here. You got to be right here. You got to be in the YouTube chat. You got to be pumping that algo. Questions, comments, stories, and jokes. Put them down there because we have so much to get to for the next 41, 42, 43 minutes. So here is the plan. I'm going to spend about 10 or 11 minutes. Let's talk about, so what do you do when an equilibrium trade doesn't work? That's exactly what's happening right now on our goal position. So if you're easily squeamish, I would look away right now and maybe turn to the audio-only version of the show. But then number two, I'll probably spend about 8, maybe 10 minutes trying to answer as many questions as I can, and then we're gonna spend the back half of the show taking our options quiz. So you have time. You've got 17, you've got 18, you've got 21 minutes. Get your own Ghost. Get your own LMNT and get your own Banana Natty ready so you can celebrate when you get 3 out of 5 correct on my quiz that is coming your way. So Ryan, bring us into the market. Man, let's take a look-see once again. Ooh, baby. Oh, yeah. So E-mini S&P is down 16. NASDAQ risk-free instrument down 180. Got the boomers down 30. Got the Russell 3000 down 36. But you got Dr. J down about 2% on the day. Yes. So this is the game that we are playing, right? I am actually so glad this happened. I mean, maybe I'm not like super glad. I'm a little bit glad though, because it's real. This is real. This is what happens to you. This is what happens to me. This is what happens to Johnny Pools 47 out there. Now, he's never going to show it to you. All you're going to see is a highlight reel on his Instagram reel feed, but it's happening to him. Oh, it's probably happening to him more than you and me combined. So this is real. Equilibrium trades are not always going to work. They are not foolproof. They are not a holy grail. They are not a 100% hit rate. And so what do we do when they don't work? Well, we're going to begin to start having that conversation now because that is exactly what is happening here in my gold trade. The one that you guys saw from this morning. So let me recap a little bit. Let me recap a couple of things because right when we, right at 10 o'clock, we had the inflation number totally made up, but it moved the market. We had, I think, another inflation number, equally as imaginary, but it moved the market. And then we had Cousin Kev come out with, like, what did he have? He had some kind of, like, lav mic that was, like, from, like, Radio Shack from, like, 1973. And he was just making it happen. And so, man, look at Manny TP. Man, that's going to help with the MGC trade. Manny TP, come on now. Manny TP, I appreciate you so very much. Thank you, thank you, thank you. And so, okay, wow, Manny TP, thank you, thank you, thank you. So generous. Not necessary at all, but so generous. Really appreciate you, Manny TP. Manny TP has been a friend of the family for so long now. And so thank you, thank you, thank you. And so so a couple of things. So 10 o'clock, the market started moving, right? You guys saw it. We were on a few extra minutes from the morning stream. But then after it was over, there was a lot more opportunity in the market. So I did a few more trades in the market. Let me take a look at the activity tab here, just to show you guys what I did after the show was over. Again, one of the things that we are going to hang our hats on with OU is transparency. The good, the bad, the beautiful, the downright ugly. Now, I would not call this downright ugly. You may differ. You may think, yeah, Jim, that looks pretty ugly, actually. And that's what makes a market, right? That's 100% what makes a market. But you guys saw me sell this GLD call against my MGC trade. That's what you guys saw. That was the last thing you guys saw, I believe. And then a few minutes after the stream was over, I was actually looking at the market because it is quite challenging to obviously go through the different things, and we go through instruction and teaching and questions and whatever and looking at the market. So when it's just me looking at the market, I can focus on it a little bit more closely. And so I was like, all right, things are moving around a good bit. I think there might be some opportunities to maybe cash in a couple of EQTs, and we were able to do that a little bit. I mean, we got MES right here for about 12.5 points. We cashed in our MES short put. That guy is over and done with. And then I did an MNQ short EQT because I wanted to match that up against my long MGC trade, trying to be mindful of my portfolio risk, but knowing now that MGC is covered by my short call, I have taken some directional bias off of that trade. And we'll talk more about that here in the next couple of seconds. But then I did another MNQ trade right here, and this is the one that didn't quite work. So we are now sitting on, this MNQ situation with NQ at 503, that's not really, that's only 150 points of heat. That's really, really not that big of a deal. Now, the gold situation is a little bit different because that's 140 points of heat. So that's a good bit of heat. That's not quite like Dr. J, stack of cash, set ablaze type of heat, but it's not too far off. It's getting fairly close there, in my humble opinion. And so we did the MNQ trade, but then the NASDAQ started to kind of get away from us a little bit. It didn't take very long, only about 15 minutes later. And so I sold a call against that guy too. Again, my general framework is, I do a tranche for the EQT, and then I typically don't do anything. I want to give it plenty of room to breathe. But then once it starts to kind of get a little too far on the outskirts of the pasture, it's like, all right, let's rein it in a little bit. Nothing super crazy, but let's go in and maybe sell a 30 delta option against that position to take that directional edge off of the trade and make it easier for us to do nothing. And so that was the idea. So that is what I have on now. I have MNQ and I have MGC. Now the MNQ trade, in my opinion, it's not that big of a deal. We've seen a lot of those. I want to spend the next, 6 or 7 minutes talking about MGC. So let's talk about MGC for a couple of seconds. Let me delete all that. Let's go back to this page because it gives me a little bit more area here. You can see right here as we grab our Diet Strawberry. That is a broad swath of area for us to work with our Final Jeopardy apparatus. So for MGC, so here's a couple of things. So the first thing, I've talked a lot about leverage points when I'm using MES, when I'm using MNQ, when I'm using equity type products, right? Well, leverage points are also equally as important when it comes to the non-equity products. However, I can't use my beta weighted delta. Like, I can't use this anymore as a reasonable proxy for how big I am with like a gold contract or a silver contract. Because just look at the gold situation. Like, if you look at gold, right, my beta weighted delta is 11. That doesn't give me any usable information. That doesn't give me anything relevant that I can use to understand, okay, what is my leverage point with this non-equity product? This would apply to gold, this would apply to silver, this would apply to bonds, this would apply to oil. And so thinking about, non-equity products, I like to go at this from a very different angle. And it's a bit archaic, some might say. It's a bit kind of, getting back down to the brass tacks here. So what I typically like to do when I start thinking about, okay, how big is one MGC contract in my portfolio, right? What is my total position size in MGC that I'm willing to consider? And then that obviously translates into, okay, so what is my plan for a trade that doesn't work, which is exactly where we find ourselves right now. Like if I open up, let me just open this up really quick just so you guys can see more easily what I have on. I'm sure that's at least reasonably helpful. Right, you can see I bought gold at 46.51 right after the big 10 o'clock, whatever it was. The inflation prints and Cousin Kev and all that stuff. And then this was the option that I sold against it. So these two are a package deal now. Those two are going together. They're working together. And I will now treat them together from this point forward. Now, I may break them apart. It's very possible that I might break them apart. But that's going to require, a very intentional goal or an intentional outcome that I'm going for if I'm going to break them apart. I'm kind of thinking about these more like a covered call now. I'm kind of thinking about these more like a package deal, just like you would with any other covered call, whether it be, shares in a short call or future in a short call, whatever. It's the same type of thing, even though there's kind of a cross product thing going on here because again, as I talked about this morning, there are no options in MGC. So this is the best we've got. Like this is the best we can do. So for MGC, man, I'm so excited about this quiz. Oh my gosh, I can't even wait. Question number 2 on this quiz. I cannot wait. It is a true-false question. Oh my gosh, man, I'm jumping out of my slides to do this quiz. It is a true-false question. And if y'all get it wrong, I'm going to be very, very disappointed in you all. Man, I cannot wait. But we'll do that here in a couple of seconds. Okay, so MGC and GLD. So when I think about gold, right, here's how I think about my leverage points with gold. And if you're thinking about EQTs, I get lots of questions about this, blah, 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 blah. Hopefully this is really helpful for understanding how I size these things in my mind. So if I look at MGC and I just look at MGC, I just look at a big move in there, which would be like $100. Right. And today it's $150, right? So it's obviously kind of outside of that, but just to use a round number, nice, big, and easy to work with, right? A 100-point move in MGC is going to be a $1,000 move in that product. What I do with that information is I then take the same move and I apply it to my portfolio. And when I look at those two different dollar movements, it helps me understand what type of move I'm looking at. For instance, if MGC moves by 100 points, that's a $1,000 move. Well, a $100 move in MGC is what? That's a little bit over a 2% move, right? I mean, if you just look at the index at 4,500, a little over 4,500, but we don't need, surgical levels of precision to get where we're trying to go here. It's about a 2% move, a little over a 2% move. Okay, now I go to my portfolio. And to do that, let's grab, we'll grab the cornflower blue here. So if I look at my portfolio now, and there's a $100 move, or I'm sorry, no, we don't need that. There's a $1,000 move. That's what I need. I don't need that again because that's obviously not relevant. The same dollar move in my portfolio. What percentage move is that based on my net lick size, right? Again, looking at the net lick, looking at the portfolio delta, looking at the theta, whatever. It just opens us up to be able to do so many new things now, which I'm just super excited about. So a $1,000 move in my portfolio is actually less than 2%. So for a greater than 2% move in gold, the resulting move in my portfolio, which you're seeing it happen right now, right? I'm getting hit by about 2% in the account. Give or take, right? I mean, it's fairly close to around 2%. For a move in gold, that's much greater than 2%. And so this actually makes the point perfectly for what I'm trying to illustrate here. For a greater than 2% move in gold, so the gold move, let me grab, let's grab a third color here just because we can. So the gold move is greater than 2%. And the move in my account, actually, hold on a second. Let me grab my... Oh no, I don't know where the eraser is. I know where like the nuclear eraser is, where I erase everything. Oh, wait. I got it. Yeah, there we go. Hold on. Let me do this right. My portfolio is going to move by less than 2% when gold moves by greater than 2%. Now, again, these are very close. It's like 1.8% divided by 2.1% or 2.2%. It's very, very close. It's around 2% in the numerator and 2% in the denominator. So let's just use 2 and 2 just to make it really, really simple to make the point that I'm trying to make. So what does this ratio tell me? This ratio tells me that one MGC contract for my portfolio size is 1x. So when I start thinking about X's and I start thinking about what I'm comfortable with and things like that, this is what I want to use. So when I think about one MGC, I'm like, for me, again, this is my risk. This is my account. This is my risk tolerance. This is not intended to be anything that you yourself should be doing out there. This is purely educational. This is not actionable in any way. And of course, 97% of you are looking at the portfolio today and you're saying, Jim, don't worry, I'm good. I'm not going to do any of that stuff. But if you did want to learn more about this stuff, then you should sign up for the Trading Lab, which is down in the description, of course. And so if I think about my leverage points for gold, I'm right around 1x. I'm pretty comfortable with that. That's actually on the lower end, generally speaking. Now, the metals, especially silver, man, silver, your underoos will never be dry. Even when things are going well, they're not going to be dry. And so when you're dealing with the metals, it's a very different ballgame than dealing with the equities, in my opinion. I'm very comfortable going up to 3x, 4x, even 5x, maybe even a little bit higher than that at times in the equities. For the metals, typically probably live between 1x and 3x most of the time. And so I have no problem maybe potentially scaling into a second tranche of MGC here, potentially even a third tranche of MGC, potentially. But right now, I'm not in a huge hurry because even with the huge drawdown today, we've still had a really solid week. And so right now, it's very much the DNS. It's very much doing absolutely nothing. But I did want to take a couple of minutes and unpack this leverage point situation because I think this might be helpful for you guys in understanding sizing the metals, leverage points in non-equities, and things like that. The next thing I want to say is, and there's a lot more to unpack here. This is, I can only, really afford in any given show to drop 1 or 2 or maybe 3 breadcrumbs on the trail because I want to get to the questions. We got to get to the quiz, of course. And so this gives you a reason to tune in next week. So now you've got to watch next week. You've got to watch Monday. You've got to watch Tuesday. Monday, we have another double feature here with you guys. So don't miss the morning show and don't miss the afternoon show. But when it comes to my maximum pain point on this trade, I don't really have one necessarily. Now, I'm not a hero. I'm not necessarily saying put this thing in the ground with me in terms of I'm just going to take this thing all the way to the end. I mean, I typically like to take it kind of asymptotically down to the end. And so thinking in terms of, all right, just put it in the ground with me as kind of my go-to default setting, I actually like that on trade entry. But when it comes down to it, if I get to a point where I'm like, all right, I'm actually good. I don't want anything to do with gold anymore. I'm done. Maybe I get a little bit of a rebound back here and we're back into the mid 54s, whatever. Then I'll just say, I'll just be done with it. I'll just be done with it and I'll move on with my life. I don't feel any type of way about needing to be right. I don't feel any type of way about, needing to avoid big losses or anything like that. I take plenty of losses. Don't worry. You saw it with Marvell. You're about to see it with MGC at some point. But I think there's a lot of power in being small enough on entry, understanding what you're signing up for, there it is again, and having your contingency plans in place. And my contingency plan right now is I'm not going to do anything. Now, if gold sinks another 100 points, another 150 points, whatever, I mean, that's where, kind of rolling out the premium and things of that nature can be really, really, really effective. In fact, one thing I did want to do, and I know this is a lot of information, but man, I picked a doozy of a day to do this quiz because, the markets are actually moving. This EQT is actually, kind of a very interesting teachable moment. One thing I am going to do, and I'll unpack the reasons behind this a bit more next week. I do want to take this 21-day option because you can see we've already picked up a couple $100 on this option. And so I chose the 21 days for a reason because I wanted the delta to be a lot, the term I've been using, at least internally here in OUHQ, is I wanted the delta to be a lot slicker. I wanted the delta to be a lot more fluid. I actually wanted that intentionally for reasons I'll have to get into next week if you guys remind me, or if I remember myself, I'll have to keep my blueberries going down the gullet this weekend. Now that gold has continued to sink against me though, now rolling out to a more standard 45 days to go type of cycle makes some sense because that delta is going to be a lot less slick. It's going to be a lot stickier. So I like to think in terms of like slick delta and sticky delta, just in terms of a way around adding premium to an equilibrium trade specifically. And so, slick delta, sticky delta, a bit of a new development here in OU, and I'll have more to say about this over the course of the next couple of weeks. But I think it's an interesting dynamic. But you don't have to worry about slick delta. You don't have to worry about sticky delta, any of that stuff. If you just want to go straight to 45 days to go, somewhere between 30 and 60 to lay premium out against an EQT that gets away from you, I think that's totally fine too. But if I go in here, I am actually going to, let me go to the trade page here really quick. Man, the show's almost half over. Man, that is crazy. Man, that is so crazy. I can't believe it. We got to do this quiz. Man, we got to do this quiz. I see you guys, man. You guys are in the chat, putting in work. Man, nice job out of you guys. All right, I'm going to buy back my 433 in September. And I'm going to sell out. I'm going to go in October, and I'm going to sell. So there is no 433, so I can't roll strike for strike. But that's okay, because I actually want to roll it out, and I want to roll it in a little bit too. Because now that gold has continued to sink, my deltas on that 433, like when I sold it, in fact, here, let's actually do this really quick. My deltas on the 433, you can see that, let me go back to the trade page. They're only like 25 now, or 24 maybe? 18. Wow, you can see my deltas on the 433 are only 18. When I sold this morning, you can go back and check the tapes because your boy does need that watch time. It was probably 30, maybe 33. And so those deltas have really dried up pretty significantly in only a couple of hours. Now, it's obviously largely because of a huge move lower, largely because of a huge move lower in gold. But I want to restore those deltas a little bit and kind of make that delta a bit more stable and a bit stickier. So let's move it out to the next cycle. And hey, if this becomes the core position, it's part of the core position. Like I see the core position is in the house. Man, I see you guys are here. Man, I see Ash Finn is here. Man, I see Danny Perkins is here. Man, look at Ryan LP. Look at Flub. Man, Sean is here. Man, Joel James is here. Manny TP is here again. Thank you, Manny. Man, it's way too generous. And so this may be a core position with y'all. Like this may just take up, one of the extra bedrooms there in the old core position mansion. And by mansion, I mean you guys are running a 2x2 ranch. But if I go ahead and do a, nothing says a Dr. Jim B- core position play than a 2x2 ranch. We have basically a 2x2 ranch, which is really, really funny. I think it's like it's a 3x2 with a back patio and, my little studio here in the backyard, which is pretty cool. But let's go. Let's buy this guy back. Let's go in October. We got to do his quiz, man. We got to do his quiz. There's so much to do, so much to talk about. Okay, so I'm going to roll it out. I'm going to roll it in a little bit to the 426. Just to bring, kind of restore my deltas to about the 35. That still gives me 65% of the upside exposure, essentially, because the conversion between MGC and GLD is effectively 1-for-1. So the notional matching between the two products is really nice because it's essentially a 1-for-1. Now, a lot of you might be wondering, well, Jim, why don't you just use GLD instead of MGC? It's because of buying power. I mean, GLD is a $400 product. To hold one GLD contract, I'm going to have to use $20,000. I don't really want to do that when I can just use MGC and I can only have to put up maybe $4,000 to do that trade. That's a lot more sensible, in my opinion. Again, you've got to choose what makes the most sense for you. I am just a faceless gnome that is wandering the streets. And so let's go ahead and make this roll. And we need a little bit more ghost, actually. Let's do, let's see. Okay, so we got it in for 615. So we are in. Man, it's so good. If you haven't had the sour green apple ghost, seriously, you are doing yourself, you are doing your family, you are doing your friends a disservice. Like, you need to go to Vitamin Shop today. You need to drop the $4 on one ghost. They're typically about $3.99, I think is what they retail for. And so you can tell them I sent you, and they may knock a little bit off the cost, or they may actually add a little bit. So it's a bit of a risk on your part. But go ahead. But go ahead and do that. Okay, let me get to... Hold on. We're going to do the quiz in 1 second, Ryan. Let me at least answer a couple of questions because there's so many questions. And this was the one day where I actually had, it wasn't just, oh, look at that EQT. It's easy. It's this, that, the other thing, which is great because this is real. Like, now the portfolio is really starting to take shape. Like, it's not all just winners. It's not all whatever. Like, it's winners and losers, which is exactly what you guys have to experience on your end. You guys are going to see me experience on my end. I mean, this is good, man, because it's real. Okay, so let's see here. Let me try to get to like at least one or two questions really, really quickly. Let's see. I see Dracos is ready with his ghost. He's ready for the inaugural OU quiz, which is awesome. But let's see. East Coast Enduro says, I'm curious if you can talk about strike selection for vertical spreads. Let's say someone wants to put on a QQQ vertical bear spread. QQQ is at 717. Does it make more sense to do $5 wide or $10 wide? Okay, great question. And the answer is actually fairly simple. So position sizing is directly tied to vertical spread width. So vertical spread width and position sizing go hand in hand. They're kind of a 1-for-1 type of thing. And so it all kind of comes back down to how big you want that position to be. And so generally speaking, collect somewhere around, I think 1/3 the width of the strikes is a great starting point. I mean, that's a tasty kind of foundational principle. I like to collect maybe more like 40% the width of the strikes, just to give you a little bit more and a better risk-return ratio. So if you're doing a $5 wide spread, you'd be collecting about $2. If you're doing a $10 wide spread, you'd be collecting about $4. And so you have to decide, do I want to risk 3 to make 2, or do I want to risk 6 to make 4? The ratio is the same. The sizing is just different. So it all comes back down to position sizing and account size. Usually 1 to 3% is a good range to live in from a defined risk standpoint. Now, as your capital grows in your account, and it doesn't even have to grow to crazy heights, but once you get to maybe 50,000 or 60,000 or whatever, I really feel like you can really live on the lower end of that range, if not even potentially going underneath the bottom of that range, to where now maybe a lot of your defined risk trades are more like 0.5% to 1.5%. So you're really shrinking that size allowing the probabilities to work and giving the math a chance to kind of play out over time. And so that's how I would think about that there, East Coast. I hope that helps. Okay, let's see though. Let me try and do one more. I see a lot of people asking about the quiz. Oh, it's coming. Don't worry, it's coming. Ryan's got it locked and loaded. Ryan, get question number 1 ready, because they're not ready. I can already sense from this crowd they're not ready. They've already mailed it in. Like, they're already thinking about the weekend. Like, we're gonna get them, man. We're gonna get them. We're gonna get them really good here. But let's see here. If I do you guys are just making me laugh. Griffin Jones adds Super Chat Telethon today. We're going to have to do that some one of these days, too, especially if this gold position keeps going down. We're going to have to start raising funds, man. Like, that's just the way we got to do it. I don't make the rules. And so stay tuned for that. That'll probably come next week. And it won't be a toll-free number. It's going to be a 50 cent a minute number. Let's see. Oh, Ryan LP, what's going on there, Ryan LP? Yesterday or the day before, you were starting to talk about a trade you like to put on in SPX towards the end of the day. I think you got distracted by the Super Chats or probably something else. Can you explain it? Yes, I can. And then after this question, we'll go to the quiz. Yes, so sometimes at the end of the day, it's almost like an end of day equilibrium trade. But a lot of times, because it's the end of the day, because what are some of the gotchas with an equilibrium trade? Because we've seen a lot of gimmies, right? What are some of the gotchas? Well, you're seeing one right now when it doesn't work. Okay, well, that's a pretty clear gotcha. But what's another gotcha? Another gotcha is, in terms of the modest profit targets relative to the commissions and the transaction costs, like, it can really start adding up. If you're doing 2, 3, 4 a day most days, and then, you go a week, you go a couple of weeks, you go, a few weeks, whatever, you're going to start to notice that the commissions and the transaction costs are really starting to add up to something significant. And hey, man, I'm outside the barriers now. I'm outside the walls. I don't give a rip how much you trade. I don't care. Trade as much, trade as little as you want to. Right? So it makes literally no difference to me. It didn't make any difference to me on theory to practice. And I really hope you guys got that feeling and that vibe, because I never, ever, ever pushed trades that I did not feel good about. And so everything on FTTP was genuine, it was authentic, and it was how I, truly felt. But now that I'm outside the barriers and I'm completely free from the walls and the chains, like, I really, truly do not care how much you trade. But still, we need to be mindful of, if I'm going to do something active, if I'm going to do something that is, kind of more well suited for, a number of trades per day, commissions make a big deal, right? They're a big factor. So the reason why I like SPX or EX, or not EX, SPX or ES, or even XSP if you really wanted to, you can get into like a deep in the money option, like a 90 delta, 85, 90, 95 delta at the end of the day. It's a 0 DTE. So it only has like an hour to go. But the nice thing is you can buy, like, I could show you guys right now. Let's go to SPX actually. Here, I'll show you guys really quickly. I mean, gold's not really, it's basically right where it was when we opened the show. So that's fine. So if I go into SPX, this is a little bit too early, for my liking, because if I go to buy a call, like, let's say I go to buy this 90 delta call, man, we got to get to this quiz. Man, we got to do this quiz. You guys are going to run out of time. Now I know you're not going to get more than 2 right out of 5, because you're not even going to get to the last 2. All right, so you're going to get 2 out of 3. But if I buy this 90 delta call at like a 76.85, here's what's really nice, right? Obviously, a lot of what we're doing is no safety net. Obviously, a lot of what we're doing, I mean, I don't know what you're doing. You've got to decide what you're doing. I'm sorry. A lot of what I'm doing is a lot of no safety net. A lot of what I'm doing is undefined risk in nature. And I like that trade. I'm comfortable taking that type of risk, because I think that that's what's going to lead to where I'm trying to go. And I think it's the best, most efficient way to go there. You may disagree, and that's what makes a market, of course. But what's really nice about SPX, or a trade like this one, and this is at 2:30. I mean, you're going to see by 3 o'clock or like 3:10, this thing's going to collapse down to, you can probably get into it for $15, right? So we can get into this trade where, okay, I know that the worst case scenario, if it just completely moves against me, evaporates all the premium, whatever, I lose 2%, I lose 3%, whatever the number ends up being. But it allows me now, if I catch, a 6-point SPX move, a 10-point SPX move, whatever, it can be a fun way to take a shot, very similar to an earnings trade. So that is my idea. That is my thinking. Because of the timing of the afternoon show, I don't know how often we will do this together, because, again, this is a little bit too early. It's great because you have more time, but the premiums are a little bit higher. You can go to ES and you can do the same thing. Let me show you guys really quickly. It should be a little bit more cost effective. Yeah, like, you can go into ES now and it's going to be, I can do the 90 delta for, you can see it's a little bit less costly. It's only a couple $1,000 because this is going to be $50 per point for ES. But the tricky part about ES is A, it's not cash settled. So if you start running it down to expiration, then, you know, you may get stuck with an ES contract if you don't get out right at the end. And also B, you know, if you run into, because you're going to be fully margined on this. And so like when you get close to the end of the day in Tasty, like they're going to make sure you have 30 grand sitting aside to hold this ES contract if that's what it comes to. And so they may liquidate your position early. I know it's happened to many of you out there. It's happened to me before. Let me know. Have they ever liquidated one of your positions early? I would like to know. And they're not doing anything wrong. They're just kind of like, hey, you don't have the capital to hold this trade. You know, it's 9 minutes until expiration, so we got to go in there and kind of close it for you. And so anyway, okay, all right. So it is time. Okay, so it is time. So this is amazing. Okay, so here we go. Here we go. This is question number 1 on the quiz. Okay, this is just a warm-up set, right? We got to get the knees loose. We got to get the elbows loose. Let's go. Question number 1 on the quiz. Go ahead and put it on the screen, Ryan, and I will read it out loud and then put it in the chat. So question number 1, what does a call option give the buyer the right to do? If you get this question wrong, Ryan has been instructed beforehand to ban you from the channel. A, buy the underlying strike at the strike price, or buy the underlying at the strike price. B, sell the underlying at the strike price. I see Ryan's got his ban hammer ready. C, short the underlying indefinitely, RIP America. Or D, receive dividends automatically. Okay, so you guys, I'm giving you guys 1 minute for each question. That's all you have. And then we shut it down. We shut it down. So you can buy the underlying at the strike price. What is an underlying? What is a strike price? What is a call option? Wow, you better have all these things locked down or you are going to be in trouble. You could sell the underlying at the strike price. That would be option number B. You could short the underlying indefinitely, taking that Tom Sosnoff approach. Or you could receive your dividends automatically. Okay, you have about 20 seconds left. Let me see how things are looking so far. All right, there's still 20 seconds left. You should be voting. And I see people in the chat say, I see people in the chat. You know, how people saying they're 1 for 1? You don't even know what the answer is yet. You don't even know what the right answer is yet. Okay, so there's your timer. So the correct answer is, of course, A. So nice job if you put A. So how many people put A? How many people put A in the chat? 96 votes. There's 270 people watching. Get in there, man. Put it out there. Take a chance, right? Just like I did with MGC this morning. Take a chance. Let me know if you got it right. So how many people are sitting on 1 for 1? Put it in the chat. I want to know. The algo is dying, absolutely dying to know. Okay, awesome. People are saying they're getting banned. Yeah, man, get them out of here, Ryan. Get them out of here, man. Get them out. Get them out. This is not a beginner class, right? We'll have plenty of those later on. No, of course, I'm kidding. I'm teasing. If you are brand new and you are a beginner, I'm so glad that you are here. Like, really, truly, I'm glad that you are here. If I can ever help, please reach out to me, man. I'm just Jim at optionsuncap.com. You can be in the chat, on the channel, whatever. Please reach out to me. Okay, amazing, amazing, amazing. Okay, so now, I see a lot of people are 1 for 1. Honestly, 95%, that's pretty good. Because this next question, you all aren't going to be so lucky, right? So again, that was the warm-up set. That was the light side of extensions, right? That was the light side of lateral raises. Now the delts are ready. Now the rotator cuff is loose. Now that shoulder joint is prepared for bombing and blasting. Okay, question number 2. Put it on the screen, Ryan, and put it in the chat. Okay, question number 2, true or false? Assuming it's held to expiration. That's tricky. Selling an at-the-money put is riskier than buying 100 shares of stock. So assuming it is held to expiration, selling an at-the-money put is riskier than buying 100 shares of stock. This one is very, very tricky. This one, you guys have about 40 seconds left. This one is a little bit clever. This one is a little bit sneaky. At the money put, buying some stock. I hear all over the internet that options are super risky, but would they ever lie to me? Johnny Pools 47 seems like he's on my side. I'm not really sure. Selling an at the money put. Does the strike price even matter? That's a very interesting follow-up question. All right. Selling an at the money put riskier than buying 100 shares of stock. Your time is now up. The answer, of course, is this is false. This couldn't be more false, right? Selling an at the money put. If you sell an at the money put, or really any put for that matter, there you go, got 103 votes. 90% of you got it right. Man, great job out of you guys. Great job out of you guys. Outstanding work, man. Selling an at the money put. This is how we make change, guys. This is how we make a difference, right? The world thinks that options are risky. They can be. The world thinks that options are crazy. They can be. They 100% can be, right? But we know that if you sell a put, actually, I kind of took it easy on you guys on that one because I was going to say at any strike, even the in the money strikes. So at any strike, it's less risky than the stock if you hold it to expiration. If you match for size, it is less risky. Let me know. I see all the 2 for 2s. Man, look at you guys, man. Preston's in the house. He wants everybody banned. That's pretty funny. I see Delta Flat, Ryan LP, Mike Franklin. Look at Ash Finn. 8 out of 2. Ash is front running all of us. So here's what's really funny. So David says, I wonder if Dr. Jim talked to his class during quizzes in college. So here's what's really, oh my gosh, this is so much fun for me. You guys have no idea. This is taking me back, man. Like this is taking me way back. And it's like, I don't even care about the gold stuff. Who cares? It'll be fine, whatever. And by fine, I mean, it's looking a little dicey. So this is going to be so much fun every Friday, man. This is going to be really, really great. So I used to, I'm just laughing because it's just so funny. I used to mess with my students so bad when we would do quizzes and exams and stuff. And I thought it was fun. I mean, they didn't really think it was fun, but I was always kind of like, it shouldn't matter. Like it literally should not matter, right? Like for example, we used to have multiple choice quizzes, exams all the time, right? And what is classic exam taking strategy if it's a multiple choice? Well, we'll get to question 3 here in a second, but when you go through when you go through an exam, what do you want to see? Like if it's like a 30 question exam, right? I'm the student, I go through, I check my answers. What am I looking for? I don't know if it's right or wrong, but I need to see a smattering, right? I need to see a smattering of answers, right? Because I'm just thinking about like a statistical distribution. I'm just thinking about a bell curve, whatever. I just want to see some kind of like mishmash, whatever, right? I don't want to see a straight line down all A. I don't want to see a straight line down all D, whatever, right? Okay. Well, on multiple occasions, I used to write my questions such that all the answers were A. 30 question test, all the answers were A. And I would see the students sitting there and they'd be checking their work. They'd be like, wait a minute. I'm pretty sure that's right. But that's the 17th straight A. That can't possibly be right. And so my students used to call me out on it. And my response was always very simple. I'm like, wait a minute, it shouldn't matter. I'm like, yes, they were all A. That's correct. But if you've got the right answer, you've got the right answer. It doesn't matter if they're all A. It doesn't matter if they're all D. It doesn't make a lick of difference, right? If you know the answer, you should know the answer, right? They didn't exactly agree with me, but that's what I used to do. Anyway, we move forward. And so I wasn't that mean to him. I did that a couple of times, and I was like, yeah, I felt pretty bad about that. Okay, are we ready? Question number 3. Ryan even says that's cool. Nah, man, it was great. Because I got to have some fun, right? It's got to be fun for me, too. I mean, the learning and stuff, like, yeah, it's all fine, whatever. Okay, are you guys ready? Question number 3. Let's go, Ryan. Here we go. Put it in the chat. Question number 3. So you sell a 30 Delta call in AMD. All right, here we go. Assuming no extra management and you hold to expiration, what is the approximate probability that you lose money on your strategy? Now, again, remember, you're holding it to expiration. There's no extra management. So, Ryan, yep, put it in the chat. There you go. Beautiful. Amazing. You sell. You guys have 1 minute. You sell a 30 Delta call on AMD. If you're listening to the audio-only version of the show today, man, then you're really getting after it because I just appreciate you. Assuming no extra management and you hold to expiration, what is the approximate probability that you lose money on your strategy? A, 30%, B, 70%, C, 50%, and D, exactly 100%. Man, this is a short call on AMD, so it does appear that D is the correct answer. I do think it's so funny that some of you guys are already calling your shots when you don't even know the answer. Some of you are already saying 3 for 3, 3 for 3. You don't know. Like, you think because you're in the group, you think because you're in the majority, you got it right. That is some dangerous, dangerous thinking, my friends. Dangerous, dangerous thinking. You would have done very poorly on my exams back in the day. Very, very poorly. So you have 1 second left. Okay, there's your timer. Can you guys hear the timer? Yeah, you guys should be able to hear that timer, right? So there's your timer. So the time is up. So the answer, of course, is A. 30%. 30% chance that you lose money. Okay, 73%. Got it right. Okay, now we do have a little bit of a smattering. We do have a little bit of a distribution happening around these answers. Okay, so I want to know how many people got all three right so far. How many people got all three right? And we're going to go extra time. Ryan said, let's do it. Ryan said he's ready to go. All right, awesome, awesome. Okay, so how many people got all three? I really, really want to know. 3 for 3, 3 for 3. There's Preston, there was Ogdenu, there's Shane, right? There's, I see Danny got it earlier, man. There's Michael Rogus. Man, there it is, there it is. There's Delta Flat. There's Point B, Stockton in the house, Ozzy in the house, Mr. Pillows, PB Krista, Greggy, man, Michael Rogus. Oh, you got it wrong. Okay. All right. Well, next time, my friend. Next time. Ashman got 10 out of 3. Not sure how you can do that. Man, Highwell Wales, DMZ, Woody Woods, BBB Fine. Let's go. Let's go. Let's go. All right. Awesome. 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 Okay. This is the one. Okay. So now, Joel James. It's 100% profit if we fade it. Oh, that's too funny. That's so funny. This is great. Oh, this is fun. Now, this is where it's supposed to be, man. So every Friday afternoon, you can expect this. Question number 4. Okay, now this is going to be my favorite strategy. So you guys know what this is. Are you ready? Let's go. Ryan, go ahead and cue it up. So question number 4. In an iron condor. Yeah, baby. Let's go. And I'm being sarcastic, by the way, if you're brand new to the show. I do not like iron condors. And we'll talk about why maybe another time. What happens to your total risk in the trade if you widen the wings while keeping the same short strikes? A, total risk decreases. B, total risk increases. C, your total risk stays the same. Or D, your total risk moves from defined to undefined. Very, very tricky. So you have an iron condor on. Man, gold is really getting smashed to pieces. That's pretty crazy. So you have an iron condor on. What happens to your total risk in the trade if you widen the wings while keeping the same short strikes? Your total risk decreases. Your total risk increases, your total risk stays the same, or your total risk moves from defined to undefined. So you have now graduated from the iron condor, and you are in the short strangle pastures. You are now in, the short straddle pastures. Okay, you guys have 10 or 12 seconds left. This one is a little bit sticky. This one is a little, talk about Delta being sticky. Man, this question is a little bit sticky. All right, so there's your timer. So your time is now up. So the answer to the question, of course, is B. Your total risk increases. Total risk increases. Who's got 4 for 4? So nice job on the poll. I see you guys, 78%. That is really, really amazing. Well done, my friends. Well. So who is sitting on 4 for 4? Who gets to continue watching the stream? Because at this point, any wrong answers, and I'm sorry, but I have to report you have now been blocked from the channel. And so who... No, man, I need as many eyeballs as I can get. Like, it doesn't make a difference, man. Right, wrong, indifferent, don't really care. I hope you come back next week. And so let me know, Mr. Pillows, Delta Flat, or Denu, man. Look at this, man. Wow, man. This is some algo. Ross got 100%. Barry got 100%. Shane Zill. There's Cornerstone. Man, look at you, Jim Dandy Field. Man, let's go. Let's go. Point B is here. Daniel Perkins, Doc, fix the ad problem. Yeah, I nuked him, man. I nuked him last night. Don't worry about the ads. That should not be a problem on the live streams anymore. Sean's digging the quiz. I'm having a ton of fun. Like, I mean, what else would we be doing? Just sitting there lamenting my goal position? Forget that, man. Now, let's just do this instead. Okay, so this is it. This is for everything. It all comes down to this, as Will Arnett would say on Lego Masters. This is question number 5. So I hope you do have your pencil. I hope you do have your calculator, because this one, you are going to need to do a little bit of math. So Ryan, bring us in question number 5. Let's see who can get 100%. So question number 5, a stock is at $100. You buy a 100-110 call spread for $4, and you simultaneously sell a 90-80 put spread for $3. If the stock finishes at 105 at expiration, what is your approximate or even exact P&L for the whole trade, ignoring commissions? A, $4. B, you lose $1. C, you gain $6. Or D, you lose $6. So A, you make $4. B, you lose $1. C, you gain $6. Or D, you lose $6. And if you want bonus points, put in the chat, what is the name of this strategy? This strategy has a name. What is the name of this strategy? Put it in the chat, and I will give you 5 bonus points. And the algo will love you indeed. So gain $4, lose $1, gain $6, lose $6. You have 15 seconds left. I used to do time quizzes too back in the day, where I would tell my class, you have 15 seconds left. They didn't love that. They didn't love that at all. And so so we are almost out of time. So let's see. Let's see. All right, so there's your timer. Time is up. Okay, so the answer, of course, for this is A, you gain $4. So A, you gain $4 on the trade. Now, I'm going to work out the math on this one just because so you guys can kind of see how I got there. And it looks like 64% of you got it correct. That is right. This is a Super Bull. That is correct. Other people have called it the stupid. That's also correct. So Super Bull or stupid, that is correct. It might be a risk reversal. Risk reversal, that might be correct. I've heard that term before. That's a very popular strategy. I've never actually used that strategy before. It could be the same thing. I think of this as a Super Bull. So let me grab my pen here really quick. So for this one, right, I bought the, hey Ryan, can you put the question up? Let me see. Can you put, okay, so I can see it. Right, you don't need to put it on the screen because we can't do both at the same time, obviously. But if I buy a 100-110 call spread, right, and I pay $4 for it, so that's -4, and I do a short put spread, I do my 90-80 short put spread for +3, and then the stock goes to 105, right? The math on this is, there's a couple pieces to it, but it's definitely workable, right? If the stock is at 105, then that means you keep the full $3 here. And if the stock is at 105, that means my call spread is $5 in the money. So this is $5 in the money, but I paid $4 for it. And this is super sloppy. And my penmanship, even when I try really hard, is not very good. And so my apologies for that. But you make $1 on the long call spread. You make $3 on the short put spread. So the net is you make $4. The answer is A. Who got 5 out of 5? Who got all 5 correct? Man, I see you guys in the chat. You guys got it done. Nicely done. Good job out of you guys, man. Look at you. Man, let's go. MP5850, 5 out of 5. Preston got 4 out of 5. Looks like Megalo got 4 out of 5, or 4 for 5. Oh, 4 for 5. Got it. 4, yeah, I had to read that. 4 for 5. 4 for 5. That's outstanding. That's terrific. I mean, that's a B-. Was there ever a doubt? Was there ever a doubt? On the first inaugural OU quiz that you got a B-. Couldn't be more perfect. Could not be more perfect. Good job out of you guys. Man, point B, 5 for 5. Juan got 5 for 5. Donald says my penmanship is terrible. It is definitely terrible. But I am drawing with a mouse, and like those kinds of things. Even if I had a pen or a pencil, it's still equally as bad. But man, wow, you guys did it. And so great job out of Ryan with the questions. Man, that was really, really awesome. Great job, Ryan. And so that's it, guys. We're done with the show. We are overtime. Man, I really hope you guys got something from the show. You know, the EQT that didn't go right. I mean, obviously, I'm going to hold it over the weekend. We'll see what happens on Monday morning. And so I'll pour out a little banana natty for this goal position. And we'll be back on Monday and talk about this some more. And then obviously double feature on Monday. Maybe quiz next Friday. If this was fun, you guys want to keep doing this, just let me know. We can definitely keep doing it. And don't forget, guys, if I can ever help you guys in any way, please shoot me an email. I am Jim Schultz. I am Jim at optionsuncapped.com. We can connect on Twitter. I'm at optionsuncapped or even at jschultzf3. Either one of those two would work. And I will see you guys on Monday. In the meantime, guys, trade them small, trade them heavy, and stay optimistic. We'll see you guys Monday.